I'm here today with Andrew Hollingworth, who is founder and fund manager at HollAnd Advisors. He's been investing since he was 14, and today he draws his investing style and approach from Warren Buffett and John Templeton. Like them, he believes in reading a lot and self-education. His website is full of interesting information for the investor, all given generously for free. And it's very appropriate that we're meeting now because he's just restructuring his fund to make it accessible to the retail investor. Andrew, thank you very much for joining us here today. So tell us a bit about your background and how that led to HollAnd Advisors.
Well, I think you've said I made my first investment when I was 14. I joined the investment industry when I was 18. I didn't go to university, just didn't happen in life, but I started learning sort of firsthand, working in some fund management roles, obviously training junior fund management roles. And then I spent about 15 years as a sell-side analyst in sectors like telecoms and transport. And then about when I was probably in my early 30s, I then really discovered Buffett and sort of all the people around Buffett. And then it just became really apparent to me that I just didn't want to be part of the sort of stockbroking, let's create activity environment rather than the thinking, careful, considered investing environment. And that's why I set up my own business about 10 or 11 years ago.
And what do you do exactly?
So we do two things, I suppose two things that we get paid for and one thing that we don't get paid for. The two things we get paid for is we run an investment fund, which has up until now been for just professional investors. And then we're, as I think you referred to, converting that into a more wider ownership retail fund in the coming months. We also write research for professional investors. So institutions who your subscribers will know subscribe to our research and they use our ideas, if you like, in their retail funds. So to that extent, we're a wholesaler of, if you like, research ideas. And then the other fund managers use those in their sort of retail funds. And then the last thing we do is we give away some of our work for free, just from a sort of calling card perspective. And just because we've learned a lot about investing over the years, so it's quite nice to share some of it. But the first two are the main activities.
And on the research side, why do people use you rather than the banks or rather than other research houses? I thought it was a very competitive area.
It is. I think the best piece of advice or feedback I've been given is sort of perspective. I mean, I've been doing this a long time. I'm 50. I started when I was 18. And I think also we believe very much in the sort of style of sort of Warren Buffett and Charlie Munger. And that's thinking in mental models rather than company or sector analysis. So we think there are commonalities between, let's say, I don't know, JD Wetherspoon and Costco, which is not what a sector analyst is ever going to do. But we see similarities in the low-cost business model. And that's something that's really helpful to a fund manager because the fund manager hasn't got time to look across the whole of the world. But he does find it helpful when you say, this business A looks a lot like this business B and C over here. And that's something that, with the respect to the younger analysts who are sector analysts who might be in their 20s or 30s, they don't have the experience to make that level of sort of cross-comparison.
And which came first, the fund or the research, or did they both come together?
The research came first because that's the job I was doing previously. So I had an established institutional client base who were kindly supportive of me when I sort of went self-employed. And many of those have been with me for many, many, many years. And it was only really once I'd sort of developed my own work sort of 10, 11 years ago that I thought, well, I actually want to do this myself. I don't just want to do this for other people. And so we set up the investment fund 7 years ago. So we did the research by itself for 4 years, and we've been doing both effectively for 11 years.
And what makes the fund different from the multitude of other funds out there?
I suppose the way I would characterise it best is that there are sort of growth investors. And in my view, right now, they are focused on growth, focused on finding companies that have got growth, but are paying up for that growth. And there are value investors. And the value investors are determined that they'll never pay more than a P of whatever it is, 10 for something or other. And we try and see ourselves as in the middle. I mean, to sort of metaphorically draw a diagram whilst talking, if you had a Venn diagram of two overlapping circles, and one of them said great companies, and one of them said price like bad companies, that's really all we're trying to do. We're just trying to find great companies at the point in time that the stock market thinks there's something wrong with them. And so if you go through our portfolio, you're not going to see Amazon and Nestle and Diageo in our portfolio because we're trying to find things that everyone else thinks there's something wrong with. That doesn't mean we won't own good companies, but we want to try and buy them when other people are not pricing them as such.
And what sort of returns are you achieving?
Since we started, the fund's up about 70% in 7 years. So we've achieved about a 10% return per annum, but it's not been in sort of linear fashion. We'd like to think that we could target a return of more in the sort of 12 to 14%. And the reason we get to that number is if you model a company and you said, right, a company could grow its revenues, let's say at 6 or 7%, which is pretty good going in this environment we live in. And then that company allocates the cash that's generated from that growth well, either buying its own shares back or paying dividends or investing in accretive growth. You can get to a point where an entity grows its intrinsic value at, say, 12 or 13% per annum. But it's pretty hard to get to one that grows at a faster rate than that. And I think, of course, if you buy those businesses cheap, you could make better than that 12 to 13%. But that means a lot of, excellent timing of buying them cheap and selling them well. And I think, therefore, to try and achieve the growth rate that the underlying companies achieve is something we should aspire to try and do. And I think we can do.
And what's your timeline? When you buy into a company, are you thinking it's a short-term opportunity due to misvaluation? Or are you looking for something that you buy and hold forever like Buffett?
As you say, Buffett's time frame forever is an excellent one to have. He's got a slightly different pool of capital with which to play with. But ours is probably a 3 to 5 year time frame. And, we generally are trying to buy companies that have got excellent characteristics for growth and intrinsic value. And so we will try and buy them when they're cheaper than normal. And some of the companies we buy will be a function of their cheapness rather than the speed of their growth. But overall, yes, we wouldn't expect to own something on average for less than, say, 3 years or so.
And what is your criteria for stock selection?
I suppose the easiest way that we would look at this is we look for 3 things in businesses. We look for great companies run by great managers, but when they're available for great prices. And that's the sort of simple strap line of how you do it. The definition of a great company, you could spend another 2 hours discussing what defines and makes a great company. And it's about moats, it's about market shares, it's about return on capital employed, it's about allocation of capital and so on. But ultimately, those 3 things are what we're looking for. Great companies run by great managers, but when they're priced sensibly or cheaply in comparison to their growth rates.
Now, you talk a lot about franchises and that you're looking for franchises at reasonable value. So could you explain a little bit more what you mean by a franchise?
Yeah. The phrase franchise has been sort of slightly overused, I think, in the investment community in the last sort of 5 years or so. And I think there's a sort of, if we could have a bubble in franchise language, now we are at the epicenter of that or the peak of that bubble. But I think we are huge Charlie Munger fans. And Charlie Munger has talked about compounding and finding franchise-type businesses. What Charlie Munger has never said is pay any price for them. And I think there's a lot of people that have learned the attractiveness of these quality companies, but now sometimes are not thinking about the price to pay for them. So that's not the answer to your question, but I think it's relevant. And the answer to your question is that, we are looking for, I wouldn't say so much good market shares as good share of mind. We are looking for businesses that do something that another business can't do.
Share of mind, what do you mean by that?
Well, how could we say? So JD Wetherspoon is a stock that we own in our fund. And JD Wetherspoon's market share of the UK pubs, I don't know, it's maybe 5-7%, something of that nature. But in terms of people knowing who JD Wetherspoon are and knowing what they stand for and knowing, what they're going to get if they go into one of their pubs and knowing Tim Martin, they've got a really good share of mind. And that means that from our perspective, not only do people know who they are, they also sell the cheapest beer, the cheapest spirits, the cheapest food that you can get. And actually that provides quite a long runway for growth going forward. So it's not just about the market share you've got, but it's also about how strong you are in your sector against your peers and how sort of well established and respected you are in your sector, perhaps.
So other qualities of a franchise? Other
qualities of franchise will always have a relationship to returns. And again, there's lots of different discussions and definitions of returns. And we've spent a lot of time sort of reverse engineering pretty much every stock that Buffett's ever bought to try and understand what they found in certain companies and what that taught us about a good investment approach. And the reason why we look at returns in the way that we do, which is return on tangible capital, is because that's exactly what we think Buffett's done for the last 50 years. And interestingly, he has started to talk about that more and more in recent years. And so that return on tangible capital is all about what capital is required to operate the business and how do the profits you're producing every year compare against that. So that gives you a feel for whether this business is a good business, because good businesses can create good returns on capital. And then you can look at the business over a length of time to feel whether that's sustainable, whether it's unsustainable, whether it can deploy more capital and invest more capital for growth, and so on. So that's if there was a single metric we would look at, it would be that. But there's a lot of other metrics about what's the customer offer like, what's the brand like, how competitive is it in its field. I mean, there's a long list of what makes a great business a great business.
And how do you value a company to work out whether it's good value or whether it's too expensive for you?
So I've lived the full spectrum I've been a transport analyst where, a company like National Express might have been on a P of 10 times for a period of time. I was a telecoms analyst when I watched my peers value everything on DCFs. And in the last 15 years of my life, I've spent, really studying the sort of good compound investors. And so what we try and do is value businesses on the most realistic set of future assumptions, if you like. And the reason I say that is because I think you have to look at, if a business has always had debt in the business, and it can afford the debt because it's got a freehold property estate, then modelling it by paying its debt down doesn't tell you anything. But equally, if you've got a business that's never bought a share back in its life and you model assuming it's going to buy its shares back, well, that's not going to tell you very much either. So what we try and do is look at the company, look at what drives its business, look at the management and what drives the allocation of capital they've done in the past, and then try and work out whether the future is going to look like that past. And if it is, that gives us a high degree of certainty that we know what we found and it has some, good level of likelihood of actually occurring. And then we'll say, okay, fine. So what are we paying for the business today? Let's say we're paying 15 times earnings for it today. What's that intrinsic value per share going to grow out over, say, 5 years? And what would be a realistic price for the person who buys the shares off us in 5 years' time to pay for it? And most of the time, we assume that the starting and ending multiple will be the same. 15 times, 16 times, whatever it's going to be. And we're interested in what happens in the growth and intrinsic value in the meantime. And if the intrinsic value grows as we expect and there's no share re-rating, well, then we might just own the shares forever. But if there was a stronger growth because the shares get re-rated, because we believe it's got repriced to be a better quality company, well, then maybe we might sell them. But it is about trying to have a realistic forecast over time of not just what the profits of the company will do, but what the cash generated by the company will be used for, and what Mr. Market might think about that business 5 years from now.
So you need quite a good historic picture to work out what the future will be. So that would exclude IPOs or relatively young companies, which tech companies tend by their nature to be quite young.
Correct.
So how do you work with those, or do you just exclude those?
We tend not to. I mean, Buffett has a wonderful expression called a circle of competence, where you should only really try and operate inside your circle of competence. And it's a lovely idea, and it's a really good sort of metaphor for how to think about making good and bad decisions in your life. But having done the job for quite a long period of time, I can tell you that you only find that you're doing things outside your circle of competence after you've done them. So by definition, you have to learn by your mistakes. And so you're right, we don't tend to look at that many IPOs. Recently, we've had a quick look at Aston Martin. We haven't bought the shares, but we're interested because it's a brand. We're good at brands. It's an unusual business with an unusual history and cachet, and the shares are down 80% since the IPO. But do we tend to look at IPOs? No, because they're puffed up by those that are selling them, but also because they might not have that much by way of a track record. So no, we tend to look at businesses that have an established track record. There's always an exception, but not very many.
So in terms of franchises that are priced at a point that you want to get in, how many of those do you have in your portfolio? and what has veered away from that strategy?
In terms of how many you have in the portfolio today, maybe we've got 7 or 8 in the portfolio today.
And how easy is it to find more at this point?
Not easy. Not easy. Maybe put it another way, how many sort of new, great quality franchises that we think are a bit misunderstood by the market have we put in? How many new ones have got in the portfolio every year? 2, 3? It's not 10. And I think if we went back 5 or 6 years, there were a lot of better quality businesses that were not priced very highly. It was easier to find, the gold, if you like. And now it's a little bit harder. And it tends to be in places that are a little bit less popular in the stock market, or where we've got a slightly different understanding to the business model than the stock market might have.
So give us some examples of those that are in the portfolio.
So one that we put in the portfolio about a year ago was Charles Schwab, which is potentially an interesting one and quite a topical one. Retail investors in the UK will understand that there's a cost of in buying and selling shares, and they'll also understand that there's a cost of holding money with someone like Hargreaves Lansdown or AJPL and so on. Charles Schwab, about 6 months ago, said commissions to buy and sell securities in America, 0. They also have an incredibly low holding cost for having money invested in a Charles Schwab account. It's fractions of the level that the UK peers have. So they've taken the sort of customer proposition and made it such good value and just kept reinvesting in value for the customer the whole time. So as they get bigger, they've given more of that scale benefit, if you like, back to the customer. And we call that a flywheel model. And businesses that have got that flywheel model, Costco's had it for years, Amazon has deployed it brilliantly. Tesco had it for a while and then sort of lost it. JD Wetherspoon, Ryanair, they've got those models. And once those businesses have those models, they are extremely hard to displace. So what Schwab did last year is they cut their commissions to 0. That hit their profits by about 10%. It hit their competitors' profits by about 25%. And what did Charles Schwab do? 3 months later, they bid for their biggest competitor. So now they're not only the biggest in the industry, they're about to become a scale even bigger again. And you get this sort of scale, volume, low price on offer for the customer that the competitors find it almost impossible to compete with. And those sort of businesses we really like. And we hadn't done the work before on Schwab to realize it had those drivers. But about a year ago, we came to that conclusion.
And any others?
I've mentioned 2 in the previous answer. So JD Wetherspoon and Ryanair, we think, have similar characteristics. They're slightly different, but they have that flywheel model where they're constantly giving better value back to the customers. A different one, perhaps, with a slightly different mentality would be Disney. So it's not so surprising that we own Disney in terms of its brands and its longevity and its return on capital and so on. What's particularly interesting about Disney right now is that Disney is basically pivoting towards a direct-to-consumer model with the Disney Plus app. And that's been something we've been following for quite some time now. And we are not surprised how successful it's been in the States. It launches in the UK in a month's time. I think it will be a phenomenal success for Disney. I mean, to put it into context for you, Disney said that they would hope to have 20 to 30 million subscribers by the end of 2024 in America. They only launched 3 months ago. They've already got 29 million subscribers. So I think this is going to be a very powerful way for Disney to take all of its products and films and characters direct to the consumer, which is something they've never done before. And stripping out some of the upfront losses and costs of that, we think Disney's on about 17 times earnings, which is actually not a particularly outrageous price to pay for all of that potential sort of future customer relationship.
And you think any hit by coronavirus, both with Ryanair and with Disney, is just a buying opportunity?
Generally, that would be our view. And it's certainly the case, I think, in Disney, because I think for all of what Disney might lose in, let's say, parks attendance, it would gain probably by people sitting at home and signing up for their Disney Plus app. I was an airlines analyst for 10 years. I've been studying them for another 10 years after that. The one thing you have to learn about airlines is there's operational gearing. And one day we think the operational gearing will work hugely in the favour of companies like Ryanair and EasyJet once the low-cost industry is consolidated. And at that point, we think you'll see slightly higher prices and much higher profits for that industry. However, anyone that's been an airlines analyst for any period of time will tell you it can also work in reverse. If there is a period of fear, if there's a period of consumer retrenchment, airlines will either lose money or not make anything like the money they're expected to make. And I think if you own airline stocks, you have to understand that and appreciate that that's part of the territory, if you like. I mean, Ryanair shares today are 14 euros. They were 16 euros 3 weeks ago. They were 10 euros in August last year. So that's part and parcel of investing in airlines.
And what about liquidity? Say you're in something like Ryanair and coronavirus takes a grip and it looks like it's a long-term problem, not a very good example probably, but you really feel the future is doomed for the medium term. What's liquidity like when you're buying in very large volumes?
That's one of the nice things about being a smaller fund at this moment in time. I think if you're sitting there running a £10 million fund, like some people in America are in terms of, and you own 30 stocks, it's pretty hard to buy and sell what you've got. Most of the stocks, so I mean, Ryanair, JD Wetherspoon, Disney, we own Wells Fargo, we own Charles Schwab, as we said, we can buy and sell probably our entire position in an hour, maybe less than an hour. Do we own the odd small company whereby it would take us a bit longer, a few days maybe to get out of our investment? Yeah, we do. But it's a small part of what we do. We think it's worth doing, giving up a little bit of liquidity just to get a little bit of performance, if you like. But generally our skill set perhaps is in the sort of mid-cap, large-cap, compounding type businesses. And that gives us ample liquidity for what we want to do.
Have you noticed a change in liquidity in small caps as a consequence of MiFID II?
Whether it's as a consequence of MiFID II or not, I don't know. I think there's always been periods of time when small caps have been illiquid and difficult to deal in. Anything we tend to buy in a small cap will tend to be because we think there's something very exceptional and therefore we probably think we're going to own it for quite a long time. So, by definition, we wouldn't really be noticing the liquidity that much because we think the stock's probably going to go up by 3 or 4-fold in a 10-year period of time frame. If it takes us a week or two to buy, or a day or two to buy, it doesn't really matter in the context of what will be probably a small percentage holding in the fund, 2, 4, 5% maximum, and then obviously we've got that problem in 4 or 5 years' time. But I think for people that buy and sell those stocks in a slightly more speculative manner, it probably affects them more, but it doesn't really have an effect on what we do.
Which small caps do you own?
Which small caps do we own today? We own a little bit of Eagle Eye. We have owned Dark Group in the past, which I think is one of my greatest regrets. We bought it well, we sold it well, or we thought we'd sold it well until it then went up another 5-fold afterwards. And we do own a few others, but I won't list them all because we only list certain names in terms of the fact sheets that we give out to all investors.
And why did you sell Dart?
I've known Dart for a long time. We bought Dart at 55p. It had 40 pence of cash on the balance sheet, but it's an airline. And it's an airline that actually, it's based up the road, but it's actually not very good at giving information out to the public. So, we'll learn more about JP Morgan by listening to their transcript on a conference call. We're not even in the meeting, than we will by meeting with Dark Group. So, it's a funny small company that isn't terribly open in some ways. At the time that we sold it, it was because they had started to spend all the cash on the balance sheet and go into debt and buy a lot of new aircraft, which was a very different skill set for what Philip Meeson had done before. And I just thought it's a period of slightly higher risk. But to be fair to him, they've executed the Jet 2 expansion brilliantly, absolutely brilliantly. So we made 4 or 5 times our money. There's a moral to the story is that, when you found a good business and you bought it well, you don't be in a rush to sell it.
When we were talking earlier, you referred to Apple and your regret around that. Can you expand?
Yes, I've looked at Apple twice in the last 5 years. I looked at it first when the shares were under $100, which was around about the time that Berkshire Hathaway bought their stake in Apple. I did my work, concluded it was a much better business than the market thought. We bought some shares in Apple, which for reasons that to do with portfolio construction and dollar, I then sold a year later at $125 or whatever else it was. So great, yes, for a short period of time, but the wrong decision. We then put a research piece together when we did a lot more work on Apple this time last year. We published a research piece for our institutional clients called Sticky, Loyal and Rich, which was all designed to explain the sort of customer base of Apple phones and how they were so loyal to the product that They wouldn't be so put off by a small replacement cycle issue. Apple shares were on, single-digit multiples or 9 or 10 times earnings at the time. We published the research piece. We were perfectly able to buy the shares. I sort of watched and waited, and the shares never quite came back, and they've pretty much doubled in a year. So, you can do all the work, but you've got to pull the trigger as well.
Absolutely. So how do stocks come on your radar? Why Apple at that time? Why were you looking at that? Why do you choose the companies that you do to investigate?
There tends to be, or rather we tend to have, a long list of companies that we sort of know about on our radar. And we might have looked at it once in the past. It might just be a company we have some admiration for. It might just be a brand that we come across in the course of our lives. And then something will happen. Share price might fall. There might be a big profits warning. There might be an industry problem. And so what is sort of bumbling away at the bottom of your to-do pile, which is forever, pages and pages high, suddenly gets pulled out and metaphorically brought to the top. Because an event happens and you go, well, hang on a minute, this is now a much cheaper share than it was. I'm going to dust those notes off, and how does it look? And so that is how most of the ideas come about. Sometimes something else happens. There's the odd occasional investor in the States that we really respect. And if they buy a share, we might go, well, I wonder why they bought that. And that'll start us working on it. But usually it's something we're already looking at, already know about. And then an event occurs, or a sequence of event occurs that starts us working again.
Interesting. And are you very America focused?
We are a little, and not intentionally. It's more to do with the fact that the sort of companies that we look for, which are industry leaders in their field, run by great managers, allocating capital well, the American market's got a lot of them. And, the UK market's got some of them, but often, well, not often, but some shares in the UK market that are great franchises, like Cadbury, for example, ends up getting gobbled up by Kraft. So, the UK and the European markets have got some good companies, but the American markets are deep and wide and have some really, really well-run businesses.
And what names in America would you take note of if they started buying into a company?
In terms of what investors?
Yes.
We're big fans. Obviously, we watch what Berkshire Hathaway do. We think that's very interesting. There's a few others we do watch, which I'd rather not name because I think you don't want to single anybody out. But there are some interesting, thoughtful investors in America who are either activists and take activist stakes in things, or they are very specialist and only looking at a small number of really high quality companies. So when someone like that does something that's unusual, it just attracts your attention. It's never going to mean that we buy the shares, but it just might say to us, this share is a slightly different share than what you thought it was. So it just pricks your attention and makes you download the 10K and read a bit more about it. And most of the time you come away going, it doesn't really change my assessment of it, but sometimes it makes you think twice about something.
And in the UK, has Brexit and the evolution with Boris now at the helm, has it made you more UK friendly, or it hasn't changed your view?
Very much so. No, we wrote a piece before the election, which was exactly on that line, which basically said that we thought that, depending on which way the election went, could provide a potential boom in the UK economy. And I think there's been a depression in the UK economy, both in terms of consumer sentiment and business sentiment, which I think the election is in the process of rebuilding. And coronavirus aside, I think once we get a trade deal, we might find a situation where the UK economy does much better than people expect. And I think that is certainly not what was priced into shares ahead of the election, or actually what's not priced into shares now.
And are there any UK fund managers that you look at and think, when they're purchasing things in the same way as the Americans do?
Less so than the Americans, actually. There's a few, and I think it's not right to name names, but there are some thoughtful people, and I think, it sounds like you're just sort of copying what other people are doing, and I'll just give you a little, well, not story, but a little example as to why I say that. So Charlie Munger I went to a Berkshire Hathaway meeting years ago, and Charlie Munger was asked, what do you do? How do you find the great ideas? And he basically said, you should do three things. Look at business spin-outs, which are businesses that spun out from other companies. You should look at the cannibals, which are businesses that buy their own shares back. And you should look at what the other smart people are doing. And I don't think that's such a crime. So, as I said, we don't buy something because another fund manager has bought it. But if a thoughtful, educated, proven professional investor is sort of saying that this is a much better business than you thought it was, well, that person's got a very interesting track record of identifying great companies. Well, yeah, I'll spend a few hours looking at it. Maybe I'll agree, maybe I won't.
So when you can't find franchises at a reasonable value, you'll move into special situations or deep value. How's that work? Because that tends to be more risky.
Yeah, in all truth, we do a little bit of that. We don't do as much of that as we used to. And I think I do like the idea of being able to be able to do more than one activity. And I think if you say to yourself, I'm a franchise investor, then that's great, but it means you have to pay up for everything. And that's dangerous. So we do believe in compounding and owning great businesses, but not at any price. So what we then also try and do is find something else to do with the money in situations. We've done one or two turnarounds before, and I think they're very hit and miss. It's very difficult to get all the aspects of operational gearing and psychology of management and get it right at a point in time. We've got one or two of them we've done well in, but we're not as successful there, I think, as we are in the sort of compounding investments. So we are just a bit selective in it, and I think as time has gone on, we've found more success in the compounding and a little bit less success in the special sits, but we do still do it. We've had some good successes in it, but we're just careful in it.
Are there any companies or sectors that you think are particularly good value at the moment?
I think it's quite interesting. There's quite a good book called The Capital Cycle, which I think it was the Marathon and Hoskin guys did. And that looks at the sort of the capital cycle in the stock markets or in the business community almost, of how sectors go through phases of having lots of capital put into them, and then that capital dilutes returns, and then actually no capital is put into them. So think about it in terms of the telecoms bubble, if you like. Too much capital went in, that depressed returns, then the industry collapsed again. And I think with that sort of mindset, one or two sectors occasionally throw themselves up. And one that we did a lot of work on and was very profitable for us was the US banking sector after the crash. So 2011, 2012, you had some very depressed share prices of Bank of America, JP Morgan, Wells Fargo, and we had a really good run of owning some of those. And in that light, I think the UK banks look similar today. They're all priced off of tangible book, whereas in the States, they're all priced off of tangible book in 2011 or 12. And in the States now, they're all priced off of earnings. So it doesn't feel like it's about to turn anytime soon because the banks are just in the process of downgrading their return on tangible equity targets, not upgrading them. But, things like Lloyds and RBS and Barclays, they're on sort of 6-7 times prospective earnings. They're extremely cheap. And the other sector I'd say is the airline sector. I think it's a sector that famously Buffett has said that you should never buy and then has bought himself. And I think because of that and other people's experiences of it, it's put people off. But it is a sector where you've seen a lot more good competitor behaviour in the last sort of 7 or 8 years. That's seen much better returns on capital being produced by the majors in America. And we think that will ultimately become replicated in Europe once the sort of low-cost war has worn its way out and everyone else has sort of failed. Hence the comments we made earlier on about our attractions to companies like Ryanair and EasyJet in the long term.
And are they your two favourite airlines?
Ryanair is the one that we really focus on in the sense that we like to have businesses that are the gorilla in the industry. They are the lowest cost producer, they have good market share, and they decide effectively when capacity is being added, they decide when fares will fall, when fares will rise. They are the one that everyone else watches. And I think to own anyone else in the industry, you've got to have a really good reason to do that. So our favourite has always, or is nearly always, Ryanair. But there are periods of time when other companies sort of come off the back of that. And I think EasyJet has done a good job in terms of the customer relationship and the brand. But if I had a different view of Ryanair, that Ryanair was one day planning to go head-to-head with EasyJet, I wouldn't have a positive view of EasyJet. So I think it's our view of the sector permeates out from our analysis of Ryanair.
Andrew, thank you very much indeed. In the interest of time, we're going to have to pause here, but we'll come back for part 2.
Many thanks.